Okay, let's set the scene. It's March 2000. Picture this. You're, say, a 25-year-old entrepreneur. You're in your cool loft office, maybe, watching the stock ticker. And just 18 months before, your startup, which, mind you, never made a dime, wasn't even expected to, it went public.
Yeah.
Valuation, $2 billion.
You were suddenly a paper billionaire, a genius, apparently.
Exactly, hailed as the next big thing. But that was March 10th.
And if you just wind the clock forward, 18 short months, say autumn 2001, the whole picture looks completely different.
Completely different. That $2 billion company.
Gone, worthless. And you, the paper billionaire, well, you're just another number in what turned out to be one of the most staggering, brutal wealth destructions we've ever seen.
And it's the sheer scale of it that just grabs you, right? Between 95 and 2000, the internet created this just unprecedented amount of paper wealth.
Unbelievable amounts.
But then, in less than 3 years, poof, $5 trillion in market value just evaporated.
$5 trillion, it's hard to even wrap your head around that number.
It really is.
To give it some context, I mean, $5 trillion back then, that's like wiping out the entire GDP of Japan at the time. It's just huge.
Wow.
But what's really fascinating for us, looking back as analysts, as historians, is the mystery at the heart of it. How did this happen, especially when the smartest people in finance seem to see it coming?
Right. Greenspan, top strategists on Wall Street, they were writing warnings. Greenspan himself coined irrational exuberance.
Exactly. The phrase itself tells you they knew something was off. So warnings were there, plain as day.
So why didn't anyone stop it? I mean, the easy answer is just, it was greed, or everyone just went crazy, and yeah, those were definitely factors.
Sure, they played a part. But what our deep dive suggests is that there was something else going on, something more systemic, maybe even more dangerous.
Okay.
Yeah, the root cause isn't just, simple human folly. It's these predictable economic forces, almost mathematical in their precision, that build up these massive fortunes.
And then tear them down.
And then tear them down with terrifying accuracy. So our thinking today, our thesis, is that if we really dig into the mechanics of that 2000 crash, we can maybe get the foresight we need to see how the next crash,
which could be happening right now in some sector.
Exactly. Wherever potential is being valued over profit, that crash is probably already baked into the system.
Okay, so let's really unpack this for you, the listener. Our mission today is to follow the timeline, follow the money, and figure out how $5 trillion just vanished. And why that story, that 25-year-old's dream turning into dust, feels so eerily similar to patterns we're seeing play out right now.
Right, so to really get the scale of this implosion, we can't just start in 2000 when it all fell apart. We've got to rewind back to the mid-90s.
Yeah, absolutely. The sources are pretty clear that there were these three kind of separate, powerful forces all coming together around the same time, creating this perfect storm almost.
A tinderbox ready to ignite. What was the first domino?
Yeah.
Well, the first one was technological. You can sort of pin it to 1991. Now, the internet existed before then, obviously, mostly academics, the military.
Right, ARPANET and all that.
Exactly. But 91 is when Tim Berners-Lee released the World Wide Web to the public. So suddenly the framework for actually using it commercially was there.
But just because it was available didn't mean everyone jumped online immediately. That's a key point, isn't it?
Oh, absolutely critical. People tend to forget this part. The growth at first was, steady, but pretty slow. By 94, only about 3% of Americans were actually online.
3%.
Yeah. So the technology is definitely cool, definitely fascinating. But the actual market size, the scale you'd need to justify the crazy valuations that came later, it just wasn't there yet. There was a ton of belief in the future, sure, but the present reality didn't match up at all.
Okay, so the tech is there, but adoption is slow. Then comes the second force, the regulatory one. And this seems to be about building the actual physical plumbing for the crash.
Yeah, this is such a crucial piece, and it often gets glossed over when people talk about the bubble. 1996. Congress passes the Telecommunications Act.
Okay, what did that do?
Well, before 96, the telecom industry was pretty heavily regulated, which made it really expensive and difficult to do massive infrastructure projects, like laying tons of fiber optic cable. The act basically deregulated large parts of the industry.
Ah, so it suddenly got cheaper and easier to build.
Dramatically cheaper. It lowered the barriers, lowered the costs, and the result? A gold rush. A literal gold rush.
To lay cable.
Exactly. Hundreds of companies, suddenly freed from these regulations, just rushed in, laying fiber optic cable across the country, building out massive server farms.
Driven by what logic?
The logic was, well, the internet is the future, right? So capacity is going to be scarce, it's going to be incredibly valuable, we need to build the digital highways now.
Okay, build it and they will come.
Except they didn't come fast enough. That's the central crippling problem that emerged. They built this immense capacity, the highway, but the actual traffic,
Yeah.
the users, the e-commerce, the data streams, it just wasn't there yet. Not even close.
But you had billions invested based on maybe 100 million users, when only 3 million were actually online.
Something like that, yeah. Hundreds of billions sunk into infrastructure that was designed for a future that was still years away. And this massive overcapacity, this building way ahead of actual demand, that became the direct cause of the multi-hundred billion dollar collapse in the telecom sector after the dot-coms themselves went bust. It was a delayed reaction, but devastating.
Wow. Okay, so technology ready, infrastructure overbuilt, waiting for users. What's the third piece? The financial force. You mentioned Greenspan.
Right. December 1996, Alan Greenspan, Fed chairman. He looks at the stock market, which is starting to get really hot, really frothy, and he gives that famous speech where he warns about irrational exuberance.
He saw it. He actually used the phrase.
He saw the signs, yes. But here's the kicker. Despite seeing it, despite voicing that worry publicly, he chose not to raise interest rates aggressively. Not enough to really cool things down.
Why not? I mean, usually when the Fed chair warns like that, they follow up with action. What held him back?
It seems to boil down to this intellectual idea that was really powerful at the time, the new economy thesis.
The this time is different argument.
Exactly. Greenspan and a lot of other very smart people genuinely believed that technology, specifically the internet and computing power, had fundamentally changed the rules of economics. They thought productivity was surging so much because of tech that the old ways of valuing companies, price to earnings ratios, things like that.
They were obsolete, old-fashioned.
Basically, yeah. They thought those old rules just didn't apply anymore in this new tech-driven era. This belief gave them essentially permission to ignore the flashing red lights from history.
So high valuations weren't necessarily irrational in this new economy.
That was the justification. Maybe these sky-high prices were justified because the internet was going to unlock unprecedented growth, efficiencies we'd never dreamed of, and that core belief that the old math of finance was suspended, that was probably the single biggest intellectual mistake that allowed the bubble to inflate so massively.
And you can see that mistake crystallize almost immediately with the Netscape IPO. That feels like the moment the market completely untethered itself from reality.
August 9th, 1995. Yeah, that date is legendary. It just completely shattered the link between a company's valuation and its actual performance, its fundamentals.
So Netscape Communications, they made the Mosaic browser, right?
That's the one. They decided to go public. And what makes it so incredible is just the basic facts. The company was only 16 months old. 16.
Practically an infant in business terms.
And they had lost money every single quarter they existed.
I remember reading that even their own prospectus basically warned investors.
It did. The legally required S-1 filing, a prospectus, explicitly stated the company expects to continue to incur substantial operating losses.
Yeah.
They were telling you, we lose money and we're going to keep losing money.
A money-losing company, barely a year old, whose main product was a free web browser.
And Wall Street went absolutely crazy for it. The intoxication with the idea of the internet, the future, was overwhelming.
What happened on IPO day?
It was pure hysteria. The stock was first priced at $14 a share. Then the underwriters saw the insane demand and doubled it to $28 right before trading started.
Doubled it before it even hit the market.
Yep. And by the end of that first day, it closed at $58 a share. $58.
Wow. So what did that value the company at?
Almost $3 billion instantly for a company with only about $16 million in revenue and absolutely zero profit.
$3 billion for a money-losing startup. That valuation basically created a whole new category, didn't it? The internet stock.
It defined it overnight. Suddenly, a company's value wasn't about earnings or assets. It was about potential, vision, being first mover, capturing mind share, profit. That was for boring old economy companies.
And the founders became rock stars.
Instantly.
Yeah.
Like Mark Andreessen, 24 years old co-founder, worth $70 million on paper overnight. And you saw him on magazine covers, famously barefoot sometimes.
Yeah.
It was the symbol of youth culture, just laughing at the old stuffy suit and tie business world. The message was crystal clear. Your rules don't apply to us. This is the internet.
Okay, so Netscape's IPO isn't just a one-off event. It kicks off this huge chain reaction, right? This self-feeding frenzy.
Oh, absolutely. It was the trigger for what you could call the venture capital gold rush. A massive feedback loop started right then.
How did that work?
Well, the VCs who got into Netscape early, they made insane returns. Hundreds, sometimes thousands of times their money back.
Right, life-changing money.
Exactly. And that success meant they could go back to their investors and raise exponentially bigger funds. Suddenly, there was just this ocean of money available for any entrepreneur who could slap a .com on a business plan.
And where there's that much money sloshing around, the big investment banks aren't far behind.
They piled in. Seeing the fees and the returns from Netscape, the banks got incredibly aggressive. They were desperately courting any startup that looked vaguely internet-related, hungry for those fat underwriting fees from IPOs.
So the pipeline just exploded.
The numbers tell the story. 1995, maybe fewer than 24 internet IPOs. By 1999, over 200. The pressure inside the banks to just find deals, get them out the door, and collect fees was immense.
And all this pressure, all this money, it fundamentally changed how companies were even measured, didn't it? Profit went out the window.
Completely. The key metric wasn't profitability anymore. It wasn't PE ratios, it was speed. Speed of growth, speed of customer acquisition.
Get big fast.
That was the mantra. What mattered was grabbing market share, getting eyeballs on your website, racking up traffic numbers, signing up users. The entire investment thesis became achieve massive scale first, crush all your competitors, and then, eventually, you'll figure out how to make money from this huge audience you've captured.
The fatal flaw being the at any cost part of achieving scale.
Precisely. The assumption was always that the winner takes all, becomes a monopoly, and can then charge whatever they want. But the cost of actually getting those customers, the marketing spend, the subsidies, the free shipping, was often astronomical. It baked failure into the business model from day one for many of them.
Let's talk about some of those famous examples of absurdity. The poster children for prioritizing hype over sustainable business.
Yeah, the classic failures. Pets.com, Webvan, eToys, they really capture the essence of the time. What's common to them is spending millions, huge amounts, often on things like Super Bowl ads.
Before they'd even figured out the basics.
Before they had cracked the fundamental, boring logistics of how to actually deliver their product or service profitably.
Pets.com is the classic, right? The sock puppet.
Everyone remembers the sock puppet. But think about their actual business. They were trying to sell and ship heavy, bulky bags of dog food directly to people's homes.
Competing with the local pet store down the street.
Exactly. Which meant they needed massive warehouses, complex inventory management, and incredibly expensive shipping for low-margin goods. The logistics were a nightmare.
And the numbers just didn't work.
The internal metrics, which eventually came out, were just disastrous. This is what makes the whole thing so baffling in hindsight. The cost to acquire a single customer, their CAC, was way, way higher than the total amount of money they could ever hope to make from that customer over their lifetime, the LTV.
So they were literally paying people to buy dog food from them.
Effectively, yes. In some analyses, the CAC was 10 times the LTV. It was a fundamentally broken model. But the stock, it went up.
Yeah.
Because investors loved the story, the mascot, the idea of buying pet supplies online.
And Webvan was similar, but with groceries, trying to solve that incredibly complex last-mile problem decades too early.
Webvan raised over $800 million. $800 million. On the promise of delivering groceries to your door. They built these huge automated warehouses, custom delivery vans.
Sounds expensive.
Insanely expensive. Yeah. And the core problem was the same. The cost of picking groceries, packing them, dealing with perishables, routing deliveries efficiently to individual homes. It was just too high. They were spending, say, $20 in costs to deliver maybe $10 worth of actual profit margin. Scaling up just meant losing money faster.
So why did smart VCs and institutions pour hundreds of millions into these obviously flawed businesses? What was the driving force?
Overword. FOMO. Fear of missing out. That fear became the dominant psychological force. Investors had seen the returns from early bets on Amazon or Yahoo. They were absolutely terrified of missing the next Amazon, the next Yahoo.
So they'd rather bet on a long shot, even a crazy one, than risk missing out entirely.
Exactly. That terror of being left behind just completely overwhelmed rational analysis. When the numbers didn't make sense, FOMO filled the gap. It led supposedly sophisticated investors to fund business plans that were, frankly, impossible.
And this all reaches a fever pitch around 1999. The market just felt like a casino.
It really did. Some of the stories from 99 sound completely unbelievable now. There was a company called theglobe.com, basically an early social networking site. They went public in 98. They'd lost $19 million the year before.
Okay.
Day one, their stock price went up 606%. 606. It was the biggest first-day IPO gain in history at that point.
Just madness.
Total madness. You had companies that had been public for maybe a month, companies with literally no product, no revenue, nothing, valued higher than established, profitable, 100-year-old manufacturing companies.
And it's easy to forget the social pressure cooker environment. If you dared to question this, if you pointed out that maybe pets.com wasn't going to work.
You weren't seen as prudent or smart. You were seen as a dinosaur, a fool who just didn't get it.
You don't understand the internet. This is different.
That was the constant refrain. It was incredibly toxic. If you tried to talk about boring stuff like unit economics or profit margins for Webvan, people would just dismiss you. It was psychologically really, really tough to sit on the sidelines while it felt like everyone around you, your friends, your neighbors, was getting rich overnight on paper.
And this whole euphoric, irrational system was greased by something darker happening on Wall Street.
Yeah.
The analyst problem.
Yes, this is a huge systemic issue, a massive conflict of interest that basically fueled the entire bubble. Investment banks have research analysts, right? Their job, supposedly, is to give objective advice. Buy, hold, sell.
Supposedly objective.
Keyword. But as this IPO machine went into hyperdrive, generating enormous fees for the banks, these analysts essentially turned into glorified salespeople for their bank's IPO business.
How so? What was the conflict?
Well, the analysts needed to maintain good relationships with the executives of these .com companies, because those executives were the ones deciding which investment bank got their lucrative IPO deal or their next round of financing.
So if an analyst issued a sell rating on a hot.com,
that analyst and their bank might lose that company's business.
Right.
Millions in fees, gone. So the incentive was overwhelmingly to issue positive ratings buy, strong buy, even on companies they knew were terrible.
Yeah.
Just to keep the corporate clients happy and the banking fees flowing.
The Henry Blodgett story really blew the lid off this, didn't it?
It did. Blodgett was the starred internet analyst at Merrill Lynch. He became famous, almost a celebrity, after he made this incredibly bullish call on Amazon in '98, predicting it would hit $400. And it did, which gave him immense credibility.
People listened to him.
Absolutely. But then later investigations uncovered his internal emails. And they painted a very, very different picture.
What did they show?
While he was publicly slapping strong buy ratings on certain stocks, telling the public to pile in, his private emails called those exact same stocks things like junk, crap, a piece of shit.
Wow.
He knew they were bad investments.
Yeah.
But his job, his bonus, his firm's profits depended on him promoting them publicly. And meanwhile, ordinary retail investors, trusting the Merrill Lynch brand, trusting his celebrity, were pouring their life savings into stocks he was privately trashing.
That's just a fundamental betrayal.
It was systemic corruption, plain and simple. This kind of behavior across Wall Street eventually led to a huge settlement, $1.4 billion, with regulators. And new rules were put in place to try and build a wall between research and investment banking.
But only after the crash, after millions of people had already lost fortunes based on conflicted advice.
Exactly. The fix came way too late for many.
And at the same time, while this is happening on Wall Street, technology is making it easier than ever for the average person to jump into the frenzy.
Yeah, the day trader revolution. Platforms like E-Trade, Ameritrade, they made trading stocks incredibly cheap, incredibly easy, instantaneous.
Taking out the middleman, the traditional broker.
Right. Suddenly you didn't need a broker. Anyone, plumbers, teachers, dentists, college kids, could sit at home and trade these volatile internet stocks multiple times a day, trying to scalp small profits.
And the media was fanning the flames.
Oh yeah. CNBC basically turned stock picking into a sport, into daily entertainment. They paraded analysts like Blodgett, they hyped the winners. And then you had the online message boards, the early chat rooms, places like Raging Bull, Silicon Investor, fueling insane speculation on penny stocks and rumors.
The danger there seems obvious now, but what was the key psychological trap?
Survivorship bias. Pure and simple.
Meaning you only hear about the winners.
Exactly. The media, the chat rooms, they only told the stories of the guy who turned $5,000 into $500,000 in 6 months. You heard those stories over and over.
Yeah.
They were addictive. They made you feel like an idiot for not trading, for not being in the game.
But you didn't hear about the dozens, hundreds, who lost everything.
Nope. The losers were silent, their stories weren't told. So you got this completely distorted view of the odds. And the sheer noise, the euphoria all around you, just made it almost impossible to step back, think rationally, and say, wait a minute, this doesn't make any sense.
So this manic energy, this disconnect from reality, it all culminates on one specific date, March 10, 2000.
That was the absolute peak, the summit of Mount Stupid, you might say. The NASDAQ Composite Index hit its all-time high, 5,048.62.
Representing how much value?
Over $5 trillion in combined market capitalization for those companies. $5 trillion. But even as it hit that peak, the cracks were already showing, if you looked closely.
What kinds of cracks?
You started seeing companies quietly missing their quarterly earnings targets. You saw customer acquisition costs starting to spike even higher as competition got fiercer. The easy money, the low-hanging fruit was gone. Markets were getting saturated. Startups were beginning to fold, quietly shutting down. The machine was sputtering.
But the really fundamental flaw, the one that guaranteed this whole thing had to end badly, wasn't about missed earnings. It was about basic math.
The mathematics of impossibility. Yeah, this is the really crucial lesson, I think. The market, in its collective delusion, was pricing internet stocks as if every single one of them was going to become a dominant monopoly in its sector.
Can you give an example of how that math just didn't add up?
Sure. Think about e-commerce back then. Okay, maybe online retail was, say, 1 or 2% of total retail sales in 2000. It was reasonable to predict it might grow to, 10% over the next decade. That 10% represents a finite amount of future revenue, right? A big pie, but a finite one.
Okay, makes sense.
Now, you had dozens of public e-commerce companies. Amazon, yes, but also eToys, Pets.com, Buy.com, Value America, on and on. And the market was valuing each of them as if they were going to capture a huge chunk, maybe 50%, maybe more of that entire future pie.
So if you added up the implied future revenues baked into their stock prices?
Their combined valuation suggested they would generate more revenue than the entire global retail sector, online and offline combined. It was just mathematically impossible. They couldn't all win. In fact, most of them had to fail for the winners to even have a chance.
But nobody wanted to hear that.
Absolutely not. Pointing this out was heresy. The few skeptics who did, like Warren Buffett, who famously refused to buy tech stocks because he couldn't understand their business models or predict their future earnings, he was mocked, called a dinosaur, out of touch.
Right. Barton Biggs, the strategist at Morgan Stanley, he warned about a bubble too, didn't he?
He did. He faced such intense criticism and ridicule from clients and the media that he actually felt pressured to partially walk back his negative views. The crowd just hates the bearer of bad news during a party.
So this collective denial lets the problems fester until they can't be ignored anymore. What were the first real triggers that started the unraveling?
The initial catalysts came right around that March 2000 peak. A few high-profile tech companies missed their quarterly earnings targets. And the market reaction was suddenly brutal. Immediate, massive sell-offs. The tolerance for bad news just evaporated.
And then there was the Microsoft case.
Yeah. In April 2000, Microsoft lost its big antitrust case. That sent a chill through the whole tech sector. Suddenly there was this fear of broader regulatory risk. Maybe these internet giants weren't going to have free reign forever.
But the real killer, the underlying mechanism of failure, wasn't regulation or missed targets. It was simply running out of cash.
That's the heart of it, the cash crunch. Remember, the whole business model for most of these startups was built on burning cash, spending way more than they earned month after month.
Believing the growth story would let them raise more money later at a higher valuation.
Exactly. They needed a continuous drip feed of external funding to survive. Series A, Series B, the IPO itself, then maybe follow-on stock offerings. They were completely dependent on investor belief and the willingness to keep writing checks.
So when that belief started to wobble,
the funding taps slammed shut almost overnight. VCs got nervous, the IPO market froze up, and when the money stopped, these companies had nowhere to go. They had no profits, no cash reserve.
the burn rate caught up with them.
Instantly, it was terminal. And then you saw the high-profile flameouts happen in quick succession. Boo.com, that trendy online fashion retailer, burned through $135 million in just 18 months. Collapsed in May 2000.
Pex.com.
Closed down in November 2000. Less than a year after its Super Bowl ad and hyped IPO.
And Webvan, the grocery delivery darling.
Gone by 2001 after incinerating over $800 million in investor cash.
And it's critical to understand these weren't just unlucky failures.
Not at all. These were companies with fundamentally broken business models, mathematical inevitabilities just waiting for the easy money to disappear. Their failure wasn't bad luck. It was gravity finally asserting itself.
And the collapse wasn't contained to just these flashy dot-coms. It spread like a virus through the whole economy. You described it as 5 waves.
Yeah, you can sort of track the contagion in waves. Wave 1 was the obvious one. The unprofitable pure-play internet companies like Pets.com just vaporized. Investors, especially those retail day traders, lost everything they put in.
Okay, the weakest go first. Wave 2.
Wave 2 hit the actual profitable internet companies. Even the survivors, the eventual winners like Amazon and Yahoo, their valuations got absolutely crushed. They went from impossible highs back down to levels that, while still high, were at least vaguely justifiable by their actual earnings potential. Amazon stock fell from over $100 a share down to like $6. Yahoo lost 95% of its peak value.
95%? Wow. Okay, wave 3.
The pain spread to the established blue-chip tech giants. Companies like Intel, Cisco, Microsoft, Oracle. They made real products, had real profits, but their growth forecasts had been based on selling tons of chips and routers and software to this booming dot-com sector that suddenly ceased to exist. So their stocks got hammered too, often cut in half or worse.
And wave 4 brings us back to that infrastructure problem.
Exactly. Wave 4 was the delayed implosion of the telecom and fiber optics sector. All those companies that laid billions in cable based on projected internet traffic. They suddenly realized that traffic wasn't coming for years, maybe decades. They were massively overbuilt. This led to a wave of bankruptcies, global crossing, WorldCom became infamous, and hundreds of billions in investments just became worthless. It was the biggest wave of corporate defaults the bond market ever seen in one sector.
Devastating. And the final wave.
Wave 5 hit the source of the initial funding, the venture capital ecosystem itself. VC firms were forced to write down the value of their portfolios, often to zero. Many smaller or newer funds just went bust, they became insolvent. The whole ecosystem contracted violently. Getting funding for any new startup, even a good one, became incredibly difficult for years afterwards.
And the final tally, by the bottom.
By October 2002, the NASDAQ had bottomed out around 11,114. That's a 78% drop from the peak just 2.5 years earlier. $5 trillion gone. Millions of people lost their savings, hundreds of thousands lost their jobs.
What's maybe most frustrating looking back is that policymakers saw this building. Greenspan warned about it. Why weren't there effective fixes? Why the inaction?
It really seems to come down to a combination of ideology and, frankly, political cowardice. Greenspan and the Fed leadership genuinely seemed to believe in the power of markets to self-correct. They worried that if they intervened too forcefully, say, by jacking up interest rates early on,
they'd be blamed for killing the boom.
Exactly. They feared being blamed for choking off innovation, for ending the party prematurely. The political pressure to keep the good times rolling was immense. The SEC, meanwhile, was just too slow, too cautious in tackling those analyst conflicts of interest until the damage was done.
So everyone could see the train heading for the cliff, but nobody wanted to be the one to pull the emergency brake because the ride felt too good.
That's a pretty good analogy. The banks were making fortunes in IPO fees. The government was enjoying the tax revenues. Voters felt prosperous because their 401ks were soaring. In that kind of environment, actively trying to slow things down was seen as politically and financially riskier than just letting the bubble inflate until it inevitably burst under its own mathematical weight.
Okay, so we've walked through the mechanics of the 2000 crash. It's easy to look back at the sock puppet and the day traders and think, wow, that was crazy, glad that's over.
Right. Ancient history.
But your sources and our analysis today strongly suggest we shouldn't be so quick to dismiss it. You're saying we are literally watching these same patterns, the same forces play out again.
History doesn't repeat exactly, but it certainly rhymes. And the dynamics of financial euphoria, the psychology, the justifications, they are shockingly consistent across time. Just look at the period we went through post-COVID, particularly 2020 and 2021.
What characterized that period?
You had near zero interest rates globally, massive amounts of government stimulus and central bank liquidity flooding the system. Money was incredibly cheap, incredibly abundant.
And we saw echoes of the dot-com valuations. Give us some specific examples.
Oh, definitely. Think about Rivian, the electric truck maker.
Yeah.
It went public with a valuation north of $100 billion.
Before they'd really delivered any trucks in volume.
Exactly. Before they had any significant revenue, let alone profit. That's Netscape all over again. A massive valuation based almost entirely on the story, the potential, completely detached from the current financial reality. Or think about WeWork.
The office space company.
Right. Their actual business was just signing long-term leases on office space and then subletting it out in smaller chunks on shorter terms. A fundamentally low-margin, high-risk, capital-intensive business. Yet at its peak, private markets valued it at $47 billion.
Despite losing money constantly.
Billions. That's your webvan parallel. A business model that just didn't work economically, funded purely by hype and the belief that scale would somehow magically fix the underlying flaws.
And just like the dot-com era had new ways for money to flow quickly, like online trading, the recent boom had its own mechanism.
Absolutely. The rise of SPACs, special purpose acquisition companies. They became this huge phenomenon.
How did they work?
Basically, a shell company raises money from the public first, with a promise of finding a private company to merge with later and take public. It became a faster, often less scrutinized way for companies, especially speculative tech companies, to get onto the stock market compared to a traditional IPO.
So, less due diligence.
Often, yes. And we saw over $200 billion raised by SPACs. Many of them merged with companies based on wildly optimistic 5-year-out revenue projections. And just like the dodgy IPOs of '99, a huge number of these SPACs has since collapsed, wiping out billions for investors who bought into the hype.
And you can't talk about recent bubbles without mentioning cryptocurrency.
No. The crypto frenzy, especially in 2021, fits the pattern perfectly. You had billions pouring into digital assets and related businesses, many with incredibly complex or questionable economics.
And very little regulation.
Almost none. It felt very much like the Wild West days of the early internet IPOs. You had massive hype, incredible stories of overnight wealth, intense FOMO, and valuations that seemed completely disconnected from any traditional measure of intrinsic value. And, predictably, it ended with major exchange collapses, fraud revelations, and vast amounts of wealth being erased.
Okay, so the patterns are similar, but your sources point to one crucial difference between now and 2000, something related to the Federal Reserve's actions since then.
Yeah, this is maybe the most important difference and potentially the most dangerous. It's what some call the new normal in central banking, and it's created a huge issue of moral hazard.
Explain moral hazard in this context.
Well, think about the Fed's response playbook. After the 2000 crash, they cut rates. After the 2008 financial crisis, they cut rates to zero and started massive quantitative easing, borrowing bonds to pump liquidity into the system. They did it again, even more aggressively, during the COVID pandemic in 2020.
So the pattern is, crisis hits, Fed steps in with cheap money.
Exactly. And doing that repeatedly over 2 decades has effectively trained an entire generation of investors.
Train them to expect what?
To believe that the downside risk is limited. That if things get really bad, the Fed will always ride to the rescue, cut rates, pump liquidity, and prop up asset prices. It creates this implicit Fed put under the market.
If you believe there's a safety net, you take more risks.
Precisely. That's moral hazard. Why not pile into super risky assets if you think the central bank won't let the market completely collapse? In a world where safe investments like bonds yielded almost nothing because of Fed policy, investors felt forced to chase returns further out on the risk curve. Speculative tech stocks, meme stocks, crypto, whatever, promise higher potential gains.
So the excesses of 2020 and 2021 weren't just random craziness. They were arguably a rational response to the environment the Fed had created.
You could absolutely make that argument. The incentives were skewed towards risk-taking. And what happened when the Fed finally did start raising interest rates aggressively in 2022 to fight inflation?
The party ended.
The cost of capital went up. Suddenly, the math for all those companies burning cash completely flipped. Their models stopped working. The Nasdaq fell 33% that year. We are still, right now, in the process of unwinding those excesses. Many companies that raised huge amounts of money at peak valuations are struggling to survive in this higher rate environment.
So the challenge for all of us, for the listener, is spotting these bubbles in real time. It's easy to laugh at pets.com now, but how do you resist the pull when you're in the middle of that euphoria?
It's incredibly difficult psychologically. The best defense we have is pattern recognition, learning from history. We can actually pull out 5 specific, reliable warning signs of a bubble. These 5 signs were all present in 2000, they were all present again in 2020, 2021, and you can see some of them flashing in certain sectors even today.
Okay, let's list them clearly. These are the actionable red flags. Sign number 1.
First, unprofitable companies are valued much more highly than profitable ones in the same industry. This is the absolute purest sign of speculative mania. If a company losing billions is worth more on the stock market than an established competitor making steady profits, the market is valuing hope over reality. Magic, over math.
Got it. Sign number 2.
Second, investment decisions are being driven primarily by FOMO, not by fundamental analysis. Ask yourself honestly, are you buying this because you've analyzed the business and believe in its long-term cash flow? Or are you buying it because everyone else seems to be making money and you're terrified of being left behind? If it's the latter, that's emotional investing, and history shows it rarely ends well.
Okay. Number 3 focuses on the narrative.
Third, the phrase, "this time is different," becomes a dominant way to justify high valuations and dismiss historical parallels. Whenever you hear experts or the media insisting that some new technology has fundamentally repealed the basic laws of economics and valuation, your alarm bells should be ringing loudly.
Makes sense. 4th sign, social dynamic.
Fourth, skepticism and criticism are met with mockery and ridicule, not with reasoned debate. If you point out flaws in a popular investment thesis and you're immediately shouted down, called a dinosaur, told you don't get it, you are likely in an irrational bubble environment. Healthy markets thrive on debate. Bubbles punish dissent.
And the final sign, number 5, goes back to metrics.
Fifth, valuations are being justified based on metrics that don't actually measure profitability. In 2000, it was all about eyeballs, website hits, page views. More recently, it might be daily active users, community engagement, total value locked, or gross merchandise volume. If the key metric everyone focuses on doesn't have a clear, believable path to eventually generating more cash than the company spends, it's likely a bubble metric designed to distract from a lack of actual profits.
Okay, so the crash of 2000 wasn't just destruction. It was also a cleansing, in a way, a painful but necessary reset that cleared out bad ideas. What are the absolutely essential lessons we need to take away from this whole $5 trillion episode?
I think there are 3 core takeaways. Lesson 1 is simple, but apparently easily forgotten. Fundamentals always matter. Always. Meaning you can ignore financial gravity for a while, but it will eventually pull you back to earth. A business, any business, must eventually figure out how to bring in more cash than it spends, period. Believing otherwise isn't being visionary, it's just denying basic arithmetic. The core failure of the bubble was this widespread belief that companies could just keep growing forever, funded by investors, without ever actually having to make money, that they could grow into their valuations indefinitely.
That sounds so obvious when you put it like that. Okay, lesson 2. This seems tied to the analyst problem and the incentives.
Takeaway 2, incentives drive behavior. We saw how almost everyone involved, the entrepreneurs wanting higher valuations, the VCs needing big exits, the investment bankers chasing fees, the analysts needing access, even politicians enjoying the boom. Everyone was incentivized to keep the party going, to inflate the bubble further.
The system itself encouraged the mania.
Exactly, which means you can't rely on the system to protect you. The only real defense for an individual investor is fierce personal discipline. It means resisting that powerful social pressure, that FOMO, even when it feels like you're the only one sitting out the dance. It's psychologically brutal, but that individual discipline is often the only thing standing between you and catastrophic loss when the system goes off the rails.
Right. And the final lesson seems to be about the mismatch between technology and oversight.
Takeaway 3. Regulation always lags innovation. New technologies, whether it was the internet back then or things like AI and crypto today, they evolve at lightning speed, much, much faster than governments and regulators can possibly understand them, let alone create effective rules for them.
Creating a danger zone.
A huge danger zone. This gap between innovation and regulation creates these windows where bad actors can thrive, where reckless behavior goes unchecked, where flawed models can attract billions before anyone figures out the risks. So the lesson for you, the investor, is you cannot rely on regulation to be your safety net. Just because something is legal or heavily marketed or uses exciting new technology doesn't mean it's a good investment or even a viable business. You have to do your own homework. Rigorously.
So the crash, as painful as it was, served a purpose. The companies that made it through the Amazons, the Googles, the eBays, they were forced to become real businesses. They got stronger because all that irrational competition just disappeared.
Exactly. The crash destroyed not just bad companies, but bad business models. And the reckoning that started when interest rates went up in 2022, it's still playing out. We are still seeing the consequences of that zero interest rate fueled mania.
Many companies are still trying to survive on the cash they raised back then.
Right. And many of them won't make it. They'll hit a wall when they run out of cash and find that raising more money in today's tougher, higher rate environment is impossible. So the fundamental question you need to ask yourself right now about your own investments is this. Am I invested in companies with real, understandable business models that have a plausible path to generating actual cash profits? Or am I invested primarily in a story, in hype, in potential that seems to defy financial gravity? Because when the funding winter comes, only the first category survives.
Okay, so we'll leave you, the listener, with this final thought to chew on. Knowing everything we've just discussed, seeing how this pattern of euphoria, denial, and collapse played out with such mathematical precision, if you could magically go back to 1999, what would you do differently?
And maybe more importantly, what are you going to do differently today? Right now, in 2025, armed with the knowledge that history doesn't just rhyme, it often repeats with uncanny accuracy. Remember, the underlying technology, the internet, it was real. It did change the world. But the valuations attached to it during the bubble were pure fantasy. The goal isn't to avoid technology or progress. It's to avoid paying an irrational price for it. It's about finding genuine, profitable growth and having the discipline to step aside when the crowd loses its mind. Because in financial markets, the crowd is almost always wrong at the extremes.
Just like we broke down this $5 trillion mistake, really getting underneath the financial forces that shape these booms and busts is so critical if you want to navigate the future without repeating the past's painful lessons.
And that's why next week we're going even further back, delving into the Great Depression, how Wall Street erased generational wealth. Thanks for joining us for this deep dive.